All right, good evening, everybody. This is John Ostaszewski, Vice Chair of the Pension Committee. We'd like to start off by noting that this meeting is being conducted utilizing electronic equipment in compliance with State Law, Public Act 21-1. As such, this meeting is being recorded and will be available to the public in compliance with state law. If you are attending remotely, please remember to mute your microphone unless you're speaking. Anyone participating remotely should state their name and title, if applicable, at the outset of each occasion that such person is speaking. All votes taken during which any member of this body are participating remotely shall be taken by roll call unless the vote is unanimous. The chat features will not be utilized nor considered during this meeting. With that, I'd call the meeting to order and we'll do a roll call. Who's on the line?
You want us to Enid Lapellis.
Thank you, Enid.
Jason Bauer, Town Council Representative.
Thanks, Jason.
Nick Kapoor, Board of Education.
Thank you. Mike, you're muted.
No, I think we lost him.
We lost him. All right. He may come back.
Do you want to just go down the list of
Yeah, so,
each committee, maybe?
yeah, so.
If that's all right with you, John?
That's perfect.
John, you're.
Start with pension committee?
Committee first, so, Mike Manjos is, was here and possibly may return. John, you're here.
Yes.
John O.
Here.
Enid, you good? Enid's here.
Yep,
Nick,
good.
Nick is here. Patrick O'Hara.
Here.
David Ferris. Here. Yeah, wow. Timing, perfect.
Good timing, Dave.
Timing.
Mike's back on.
Jason Mauer, we're good there. Mike, you're here? I think he's muted.
Not sure what he is.
Unmute yourself, Mike. Oh, maybe that's.
And Ken, First Selectman Ken Kellogg
Here?
is here. Superintendent Joe Cobza is not here for the pension committee. Am I missing anyone for pension?
I think that's it.
Yeah. Okay,
OPEB?
now Opeb, Board of Trustees. First Selectman Ken Kellogg.
Here?
I'm here, Ron Bonofsky. Chairman Mike Vitello is not here. OPEB Board Vice Chair Mike Manjos is on the line. He's muted.
Mike, can you hear us? I'll text him.
I did.
Oh, you did already? Okay.
Okay, and Jonathan Cello?
Yeah.
For the OPEB Board. OPEB Board of Trustees. Okay, that's it.
It's everybody?
That's everybody.
Great. Start off with review of the minutes. First, the pension committee. Anyone have any comments, questions, changes? If not, we get a motion to approve. So moved.
Second.
That's Patrick and Dave. Thank you. We'll do a roll call for all.
If it's unanimous, you don't need to?
Are there any objections?
Can you make a question?
Hearing none, it passes unanimously. Thank you.
And again, the minutes are joint with the OPEB Board of Trustees, so.
Should probably be a separate vote for OPEB.
Okay.
Yep.
So the OPEB minutes, are there any comments, questions, changes? Hearing none, if we can get a motion
Motion to approve the minutes.
So moved.
and a second.
Second.
Ken, second. Thank
I'll
you.
second it.
Enid's actually on the pension committee.
Right.
She's not on the OPEB board, so she can't.
Actually, she's,
Okay, no problem.
John's the chair. Later. All right, vote.
If there's no objections, pass unanimously. Thanks very much, everybody. All right, new business. Defined benefit plan, quarterly investment review, third quarter of 2021, another exciting year. Devin, you now have the floor.
Okay, wonderful. Would you like me to share my screen electronically, or since everyone has either an electronic or a hard copy of the report, would you like me to just refer to page numbers?
Devin, stand by. I'm going to let you do both. Hold on.
Okay, great.
Assuming the technology wants to cooperate this evening. You should have access to share your screen now.
Okay, great. Okay, so you're seeing this page, the cover page of the report, correct?
Yes.
Yes.
Okay, wonderful. So I just made it bigger. Hold on one moment while it catches up. Okay, and are you also seeing the funny, the pictures, or no, you're seeing the report unobscured?
Report unobscured.
Perfect. Okay. So we've got just a couple updates, our recent educational pieces and upcoming newsletters and that sort of thing. A snapshot of new folks that we welcome to the firm in 2021 and some recent research pieces. So if you are so inclined to look into those at any point in time, please feel free. So the governance calendar this quarter focuses on the municipal landscape as well as a review of the actuarial health of the plan. So what you can see here is that we have the town plan in the top half of the page, the Board of Ed plan along the bottom, and I'm looking at page 7 of the report. So we have the 2020 valuation report alongside the 2019 report. What you can see is that the funded status of the town plan stayed right about the same, ended 2020 fiscal year at 94% funded with an actuarial return assumption of 6.75%. And the Board of Ed plan is in a similar position, ended the fiscal year 2020 with a funded ratio of 90.8%. And the same actuarial return assumption of 6.75%. I will note that the funded ratio of the Board of Ed plan did drop slightly from 2019 to 2020. However, if we look at the next slide, you'll see that the return for the fiscal year for kind of this is the 100 largest U.S. public pension plans, but really the results were pretty similar broadly. The fiscal year return was almost 20%. So because of that very strong return in assets over the course of the fiscal year, when we see the 2021 valuation, the expectation is that funded status will have improved significantly. Some folks are expecting even as much as a 10% improvement, 10 percentage points improvement in funded status, which, you know, I'm not sure if we should expect quite that much, but certainly the strong fiscal year that came to a close at the end of the second quarter will be a benefit. If you look at the 2020 fiscal year return, you're looking at a very modest return, only 3.8%. I don't know of any public plans that have an actuarial return assumption that is that low. So in almost all cases, public plans did not meet their return expectations over the course of the fiscal year 2020. The fact that we locked in such a great year in fiscal year 2021 means that we are probably going to see an improvement in funded status. So what this slide shows, I'm showing page 9 right now, this shows the average funded ratio between fiscal year end 2020 and 2019. You can see that there was a deterioration in funded status between 2019 and 2020. And we do expect that we will see an improvement when we look at the 2021 numbers. Broadly speaking, most the largest percentage of plans were somewhere between 70% and 90% funded. So the town of Monroe is in a little bit better shape. I think last time we did a broad survey of Connecticut municipalities, the average funded ratio was 76%. So in both cases, you're above 90, so you're well above that average. And the average actuarial return assumption was 6.76%, so you're right in line with that. So you're better funded with the same return assumption as what we're seeing in most municipal plans. Then the final section just refers to Opeb plans. The funded status of Opeb plans is much weaker. Of course, you see a large percentage of plans that are actually 0% funded. And then, very, very few are fully funded. You fall right in this I'm looking at page 10. You fall right in the category of 20 to 40% funded. As of the 2018 report, which is the last one that I saw from the folks at Hooker and Holcomb, your Opeb plan was about 35% funded. So it may have improved since that point in time. I haven't seen an updated Val report. But only 10% of Opeb plans have a funded status above 40%. So you're certainly in good company with your funded status, and you are better than the average. The discount rate that is being used for the Opeb plan, according to that valuation report that I saw from Hooker and Holcomb, was 6.5%. So a little bit more of a modest return expectation than the pension plans. So any questions on anything in the governance calendar? Okay. Do we need to formally move on to the capital markets overview, or can I just keep steamrolling ahead?
You are welcome to steamroll.
Okay, wonderful. Consider it done. I'm good at steamrolling. So I won't go through all of these slides in the capital markets review. I will say that, we did experience, and for those of you who pay attention to the markets, I'm sure you noticed this, we experienced a bit of a pullback in the month of September. That was due to a couple different factors. One, of course, is the ongoing struggle with the Delta variant. Another is fears of inflation, and particularly with a lot of the supply chain disruptions we've seen, the fear that perhaps the increased inflation numbers are maybe here to stay for a bit longer than folks had expected. If you had asked us 3, 4, 5 months ago, we would have certainly said that our thoughts were that inflation, that the high inflation readings were very transitory. I still don't think that we are getting into a secular high inflation environment. I don't think that these inflation figures will be here to stay for a very long-term time frame. However, some of the supply chain disruptions, the magnitude of those disruptions and the expectation of when they will be alleviated is perhaps a bit longer than folks were thinking. So I think that was something that fed into a little bit of the market pullback that we saw in the third quarter. Another issue is the likelihood of the Fed beginning to taper its bond buying program at some point in the fourth quarter, and then perhaps begin raising interest rates maybe as early as late next year. I think that also weighed on investors. So we did see a bit of a market pullback. The one thing that I will say is that the consumer remains incredibly strong. So if you look at page 6, the graph on the bottom left side of that page highlights the strength of the consumer. The navy blue line is household debt, which you can see has come down very substantially over the last 15 years. And the lighter blue line is household net worth, which has increased substantially. So really, consumers are worth more than they ever were before. They have record low levels of debt. Savings rates are not explicitly shown on this slide, but savings rates are higher than they've ever been. So the consumer is remarkably healthy. The consumer is responsible for about 70% of GDP. So the fact that the consumer is in such a good place financially leads us to believe that the broad economy and therefore markets should probably continue to perform pretty well. If we move on to the next page, page 7, and you look at GDP on the top left-hand side, we show the actual GDP figures for 2017 through 2020, and then we show the estimates for 2021 and 2022. And what you can see is that those estimates are substantially higher than the figures that we've actually experienced over the past 4 years. So again, this is kind of another factor that leads us to be somewhat optimistic about the health of the economy and the potential performance of markets going forward. If we move ahead a couple slides, one of the things that I'll point out here is we often spend time talking about valuations. And so what you can see on the top left-hand side is equity valuations. This is over the last 15 years, where the blue, so the navy blue bars represent the range of equity valuations. So kind of the median plus or minus 1 standard deviation. That light blue bar right in the middle, and I'm sorry if I didn't mention the page number, I'm on page 10. The light blue bar right in the middle is the median valuation. And so we show US, international developed, and emerging markets. What you can see is that in all cases, we are above the median in terms of equity valuations. However, we have come down compared to where we were a quarter ago. And when we showed this chart last quarter, we had come down compared to where we were the previous quarter. So valuations, that means equities prices relative to their earnings, are becoming more reasonable. And the reason that they're becoming more reasonable is not because equity prices are dropping, but it's actually because the denominator earnings are becoming healthier. So that's good. What we don't want to see is a bubble that is hovering way above median and above that broad trading range. So we think that the fact that valuations are coming down is a good thing for the markets. So if we move ahead just a couple pages and we look at the financial market performance, again, over the course of the quarter, we did see a little bit of a pullback. Certain areas of the market held up better than others. So for instance, S&P 500 was positive for the quarter, up 60 basis points, whereas the Russell 2000, which represents small cap stocks, was pretty sharply negative, down 4.4%. It was really a risk-off environment. We saw some of the things that performed well right after the onset of the pandemic, like large cap stocks. We saw those areas of the market perform better, and we saw the quote unquote riskier areas of the market struggle. However, if you look at the 1-year results, you're really looking at remarkably strong performance across the board. The S&P 500 up 30%, small cap stocks as measured by the Russell 2000 up 47.7%, international stocks as measured by the MSCI All Country World ex-US Index up about 24%, and commodities north of 42%. So really a diversified portfolio has performed very, very well. Fixed income has been a headwind over the course of the past year. So the Barclays Aggregate Index is negative on a 1-year basis, down 90 basis points. And that's really because we've been in an environment of rising interest rates. So if we look at the 2021 calendar year, the 10-year US Treasury started the year with a yield of 93 basis points, 0.93%. It's now between 1.55 and 1.6%. So you've had a substantial increase in interest rates. Remember that interest rates and bond prices have an inverse relationship. So when you see rising interest rates, you have falling bond prices. So the rising interest rate environment has been really tough for fixed income investors. I will say that your fixed income portfolio has held up quite well because you have diversification away from just US interest rate risk. So Overall, I'd say you have a shorter duration profile. You also have exposure to an unconstrained strategy. You have exposure to global bonds. So that diversification over the course of the year to date and the 1 year period has certainly been helpful. So that's it in terms of financial market performance. Any questions about anything that I've covered in that section?
Nope.
Okay, great. So if we move on and take a look at some of the portfolios specifically, we have the town plan on page 21. And that plan ended the quarter with a portfolio value of 15.6 million. You will see when we look at the asset allocation profile compared to the target allocation, we're pretty substantially underweight fixed income and overweight equities. And some of that is by design. We did have a tilt towards equities and away from fixed income, but some of that is also reflective of market movement. So where the markets have led us over the recent history when we've seen struggles from fixed income. So we do intend to rebalance closer to that target allocation. However, we are recommending several portfolio changes, primarily to the fixed income segment of the portfolio, and I'll detail those changes in just a few minutes. Another change that we are recommending is you'll see the second strategy listed within the domestic equity segment is the Vanguard Value Index. So you may recall that we had talked about a couple of years ago how growth had substantially outperformed value and how it had outperformed on kind of a consistent basis over the course of several years. And the expectation of a reversion to the mean, where generally markets come back into some semblance of balance, you don't tend to see one style or one asset class outperform forever. So usually you have cycles of outperformance and then kind of that reversion to the mean. So when we added this value index exposure to the portfolio, we had been experiencing a cycle where growth had substantially outperformed, and we wanted to have that kind of value tilt in the portfolio. Value has actually come back, and over the course of the past year, it has regained a lot of, it's made up a lot of the ground that it had lost to the growth side. Right now, we'd like to neutralize the portfolio. So we no longer want to have that style tilt in the portfolio. So we'd like to eliminate the Vanguard Value Index and just roll that 5% target allocation back into the Vanguard 500 Index, which is the broad S&P 500 mandate that includes both growth and value companies. So we'll talk about that when we get to the point in the agenda where we can vote on these recommendations. But in terms of the managers in the portfolio, even though we are recommending the elimination of the Vanguard Value Fund and we're recommending several changes to the underlying managers in the fixed income portfolio, none of these managers that are in the current portfolio are on watch or terminate status. We don't have any significant concerns about these particular managers or the strategies. It's just a portfolio construction issue that we want to make sure that your portfolio is reflective of our best ideas. So if we look at the next page, that's page 22 in the report, you can see again a bit of a pullback in the quarter, down 30 basis points, but you have outperformed your benchmark for the quarter. And on a year-to-date basis, your portfolio is up 8.1%. Again, ahead of the blended benchmark. And on a 1 year basis, the portfolio is up 21.4%. So you've not only handily beat your benchmark, but you've also produced very, very strong absolute performance. Remember that our return target is 6.75. So it's been a remarkably strong year, but you still have strong results on a 3 and 5 year basis, as well as since inception. So going back to when we first began working with the town, in 2015, your portfolio has produced an annualized return of 7.7%. So again, significantly beating that 6 3/4 return objective. If we move to page 28, We can see the snapshot of the Board of Ed plan, very similar profile, all of the same underlying managers. We ended the quarter at about 6.4 million for that portfolio. And again, we are underweight fixed income, overweight equities. When we rebalance the portfolio, raise cash for upcoming pension payments, and possibly make the manager changes that I'm going to be recommending, we'll get back closer to that target allocation profile. And then, of course, we have very similar performance for the Board of Ed plan, 21.4% on a one-year basis. And then the since inception return of this portfolio is 7.6% annualized. So broadly speaking, a couple of the highlights in the portfolio have been the fixed income managers. So if we look at page 36, you'll see the fixed income managers are the group of 4 managers listed here. And on a one-year basis, even though the Barclays Aggregate Index has been negative, down 90 basis points, all 4 of your fixed income managers have been positive. So we've got PGIM and BlackRock are the 2 kind of most traditional managers within the portfolio. They're both up right around 1.5%. We've got JP Morgan Strategic Income Opportunities. That's the unconstrained go anywhere fixed income strategy. That's up just shy of 2%. And then you Brandywine on the global bond side, which is up 5%. So a lot of the outperformance on a one-year basis has been driven by the fixed income managers. You also see that on the domestic equity side, we've got a fair amount of indexing. Both the Vanguard 500 index and the Vanguard Value Index are passive strategies. And then we've got active management on the small cap growth and value side. So we've got Diamond Hill on the small cap value side. Very strong relative performance on a 3-year basis, a bit behind in terms of relative results on a 1-year basis. But when you look at the actual returns, you're looking at a return of 51% over the course of the last 12 months. So certainly, we're happy with that performance. And then Conestoga was a fairly new addition to the portfolio. That's shown on the following slide, page 37. The Conestoga Fund replaced the Eaton Vance small mid cap fund, which had struggled in terms of performance. And you can see for the quarter, the Conestoga Fund was up 3.6%, whereas its benchmark was down 3.5%. And that number in parentheses is the percentile ranking. So Conestoga for the quarter ranked in the top 1% of the peer group. So compared to other small and mid-cap growth strategies. We don't hang our hat on quarterly results. It's really the longer term that we're looking for, but it's certainly off to a good start for Conestoga. And then on the international side, we've got a blend of 2 active managers, MFS, which is more of a growth style manager, and then Lazard, which is more of a value approach. And then we have Harding Loevner on the emerging market side. And then finally, the last holding in the portfolio is the Principal Diversified Real Asset Fund. So this has been in the portfolio for over a year. So it was mid 2019 that we added it. So we're looking at just over 2 years of performance. And that strategy has exposure to TIPS, REITs, so real estate, infrastructure, natural resource equities, and commodities. So basically everywhere that you could want exposure within the real assets universe, they have it, and they have performed well since they've been added to the portfolio. So are there any questions on anything in terms of performance or any of these underlying managers before I move to the recommendations?
John,
Dave, yes.
am I reading that correctly, that both plans are currently 100% funded?
No.
No. They
About
are.
funding earlier, Dave, I'm sorry.
No, it's okay.
They're-
I'm not making everyone busy by going back.
Low 90s.
Right.
Yeah, 94% for the town plan, and then 90.8 for the board.
I think what he's getting at, Devin, is
The other slides.
yeah. So the current value of the assets are now what, over 15 million?
Oh, yes,
Like
that is true. I'm not sure where the liabilities are right now.
Yeah, we don't have the other side of that equation, Dave, to make the
Okay,
calculation. We can
it
do
was, it was somewhere around there. I was looking at, they said 100 and 100, so, okay. Okay.
I've got a question.
No, thank you. It's very good. Whether it's 90 or 100, it's very good no matter what.
Good observation. Thanks, Patrick.
Devin, question on, and forgive me, my page numbers at the very bottom are cut off, so I don't know what page I'm on.
Sorry.
But it says, but essentially it's a short-term liquidity line, Wells Fargo money market fund, market value as of 7/1/2021, $500,000. If I understand that line correctly, that's generally the line we reserve to pay out benefits, correct?
Yes, it is.
Does that normally sit at around $500,000, plus or minus, as we have net flows out and flows in?
No, what it does is it's the way that we do manage the liquidity is we raise sufficient funds to cover about 3 months worth of pension payments. So
Okay.
kind of shore up the cash reserves, and then we pay out those pension payments over time, and then we'll raise money again. So it's kind of just at a point in time. So if you're, I see that we have, as of the end of the quarter, we had about 170,000 in the town
Excellent.
plan. And then about 320,000 in the Board of Ed plan. And that's really just a function of the point in time whenever the quarter ends, how much had gone out in terms of pension payments. But that's how we handle it. Is we raise 3 months worth, we let that get depleted over the course of the quarter, then we'll raise it up again to cover the next quarter's worth of pension payments. We don't have a target to cash. We don't think that cash is a good investment from a return perspective. So
That's exactly where I was going with the question, was just to determine what kind of philosophy you had with, on a monthly basis, what was in cash, because cash is bad.
Yeah, I agree.
Okay. Yeah, you got me where I needed to go, so thank you.
Okay, good, you're welcome.
Thanks.
Any other questions?
I think we're good.
Okay. So if we can move on, I'm sorry, I'm going to make you dizzy again. We'll go to page 43. And we just have a synopsis of at the top of what activity has already happened this year. That was the replacement of the Eat Advance Fund with Conestoga. But we do have some recommendations, which I've already kind of teed up for you. So we'd like to reallocate the fixed income portfolio, and then we'd like to eliminate exposure to the Vanguard Value Index. So you can see kind of the ins and outs in terms of the current target allocation and the proposed target allocation. So one of the things that you'll notice, the strategies that are listed here in red are the strategies that we are hoping to eliminate. And then strategies shown in green are new strategies that we're hoping to add. One of the things that you may notice is that there's some overlap in terms of the fund companies. So you might look at this and say, okay, they're telling us to eliminate the BlackRock Total Return Fund, but then I see an addition of a different BlackRock fund, the Strategic Income Opportunities Fund, and they're telling us to eliminate PGIM on the traditional fixed income side, but then add it on the global side. What's going on? So basically, as I mentioned, none of these managers that are currently in the portfolio are on watch or terminate. They are all on maintain status. We are comfortable with them. However, through the process of, and I've talked with you over the course of the past year or so about the integration of our two manager research teams between the legacy FIA team coming out of Connecticut and the DeMeo Schneider team out of Chicago. And, I mentioned that as the two teams were integrating, we were kind of culling down our list of best ideas and our most preferred managers in every asset class. So these strategies that you see in green are reflective of our best ideas fixed income portfolio. So if we were to build a portfolio from scratch, how would we allocate assets within fixed income? We like MetWest and Baird as a pairing for the kind of traditional piece of the fixed income portfolio. So those are the strategies that are going to be most similar to the Barclays Aggregate Index, but they do have some credit exposure and exposure to, the Barclays Aggregate Index is about 65% treasuries. These strategies are more diversified. So we like MetWest and Baird together. We think that BlackRock does a particularly great job in the unconstrained space. We use the Strategic Income Opportunities Fund in probably about 80% of our portfolios. And we prefer it to the JP Morgan fund. The reason that we want to eliminate BlackRock Total Return is that they have some of, it's a similar portfolio feel. You're talking about the same pool of analysts. Rick Reeder, who is the portfolio manager for the Strategic Income Opportunities Fund, also has influence over the Total Return Fund. So we didn't want to pair BlackRock with BlackRock. We wanted some entity diversification. So that's why you see us getting rid of BlackRock in kind of the traditional fixed income space and moving to them in the unconstrained space. And then swapping out Brandywine in favor of the PGIM Global Total Return Fund. Brandywine, as you saw over the course of the past year, produced a return of 5%, sharply positive, whereas the benchmark was negative. But Brandywine's return profile tends to be pretty volatile, and PGIM is a little more steady. So, it's the nature of global bonds. They're probably going to be more volatile than domestic bonds, but the PGIM return profile has lows that are not as low and highs that are not as high as Brandywine. But we think that this is actually a good time to be getting out of the Brandywine. So I'll pause there, ask if there are any questions about our recommendation.
So I'll ask a question. Did you, or can you tell us what the return would have been over the last year if we had allocated these at the beginning of the year?
Oh, that is a great question. I cannot tell you off the top of my head, but I know that I can find it pretty quickly because a lot of our clients do have this same blend. So if I can get back to you, John, with that. We do have in the back of the presentation, we have the return streams of all of these managers individually. So I'd need to do a back of the napkin kind of calculation and I could come up with it.
That's fine. Yeah, I didn't expect you to have that, but if you can get that back for the committee, that'd be great.
I have a question.
Sure. Yeah.
And Patrick has a question.
Devin, your 30% fixed income, listening to the presentation of where you see us going over the next year, are we locked into a 30% number on fixed income, or is that something you would dare to go a little smaller on? Or, I mean, obviously,
go ahead.
Equities seem to be the way to go with all the information you're giving us and what I'm seeing out in the world. So do you have any thoughts about going a little more aggressive into the equities and away from the fixed?
Yes, we do have thoughts on that. We would be in favor of that. Next quarter's governance calendar actually includes our asset allocation modeling. So at the end of every calendar year, we come up with our revised capital market assumptions. Our capital market assumption for on a 10-year basis that we developed at the end of last year for U.S. bonds was only 2.1%. So if you think about the expectation of generating a 2.1% return, then you have to strip out inflation. You're actually looking at probably a negative real return for bonds. And that was going into this year. So I'm not quite sure how our expectations will be adjusted going into next year. But I think that I don't want to give a recommendation, a specific recommendation right now. I'd like to see the asset allocation modeling, which will show for your current portfolio as well as for a blend, a combination of maybe a couple different portfolios. what the return expectation might be and what the potential drawdowns might be. But I would say, broadly speaking, we have been directing clients towards more equity heavy and fixed income light portfolios, just given the fact that the prospects for fixed income are not particularly attractive. And that's actually why, so you'll see in this portfolio that we've proposed here, we're moving from a 20% allocation to kind of core traditional fixed income down to a 17% allocation, and we're increasing the exposure to kind of the more opportunistic fixed income, simply because we don't think that plain vanilla fixed income is going to be, a great driver of returns. It's important to keep exposure in a portfolio like this because it serves as a ballast and helps provide downside protection. But yeah, when we look at the next 10 years or so, we don't expect to generate great returns from fixed income. So I think we'll definitely put it on the docket for next quarter, but I think moving towards maybe a 25% return or 25% fixed income target, or maybe even a little bit lower, is certainly up for discussion.
All right, so your answer to my question is yes, but next meeting.
Yes.
Thank you.
Sure.
So you can ask your question again next meeting.
No, next meeting, I expect Evan to show up with a 25% or lower allocation in fixed income for us.
But you may want to lower it.
Yep.
You got to see what the model says, actually.
I guess
it's a valuable exercise.
I guess the thing I would offer right now, just as an opinion and from what I'm seeing, is I think going more aggressive, like even with what you're telling us, Devin, on the fixed income, you're looking at more aggressive fixed income opportunities. That makes sense. And more exposure to equities, and that makes sense. And the sooner you get into the equities, the sooner it makes sense, because equities return over a longer runway. So the longer the runway, the better the return.
Right.
So for me personally, when you come back, yeah, I'd love to see you being as aggressive as you can be, obviously within the realm of what we're doing here and what your constraints are and what everybody else thinks.
Yep. And just as a reminder, if we were to go back to the asset allocation snapshot as of the end of the quarter, we're significantly under, so we're below that 25%. We're at, 22, 23%. And we have carried a fairly significant underweight to fixed income throughout the course of at least on a year-to-date basis. So we have had that positioning. It's just formally updating the target.
And the allocation is a product of the advance in the equities versus the decline in the fixed.
Yeah, it's partially a result of that, but it's also partially an intentional underweight to fixed.
Yeah. Okay. Thank you.
Sure.
Any other questions?
Any other questions?
Oops, sorry. Hearing none, I put this out for, sorry.
Oh, no, I forgot. Yes, we do have to vote on it. I was just going to, again,
Is this
steamroll.
OPEB or pension? Is this OPEB or pension?
This is pension.
This is pension only.
We're still on pension. We haven't gotten to OPEB yet.
You want a motion to accept the recommended changes?
I would love one.
I make a motion, we accept the recommended portfolio changes on page 44.
That's Patrick.
I'll second it.
Enid, thank you. Second. Any questions or concerns?
I'll just say for the record, it makes sense what you're doing, Devin. The way you're making these changes, so the overlaps are in some cases less of an overlap, and where in other cases they make more sense as an overlap.
And if there's no objections, the vote will pass unanimously. Thank you very much. Now you can go to your OPEB review.
Okay, and that will be much quicker. So on page 46, you can see a snapshot of the OPEB. We ended the quarter at just over 1.8 million. And this portfolio is all indexed. So we've got the money market index, we've got the Vanguard 500 index on the large cap domestic equity, and the extended market index, which covers small and mid cap. And then on the international side, we've got the total international stock market index and then a real estate fund. So we've talked for a while about how at this small size, having an all passive portfolio makes sense. At some point in time, we may come to you with a recommendation to add some active management, but we think that this is appropriate and certainly in line with most Opeb plans are doing at this point in time. So if we look at the performance, of course, it's going to be more closely aligned with the benchmark. So on a year-to-date basis, the Opeb plan is up 7.7%. On a one-year basis, up 19.4%, and then 11.3% on a three-year annualized basis. And we've been overseeing this plan since midway through 2018. And the annualized since inception result is 10.8% per year. So, it's obviously been a good market environment for the Opeb. Nothing to report on any of the underlying managers, as you would expect. There's a, fairly modest amount of tracking error. There's always more tracking error in the international market. So that's why you see a bit of a discrepancy between the Vanguard International Fund and its benchmark. But broadly speaking, these funds are doing what we would expect them to do. So there are no recommendations to make any changes to this Opeb portfolio. Any questions or comments about Opeb? Okay. That is it for me. Let me see if I can. I don't want to leave the meeting. I want to stop sharing my screen. There we go. Stop sharing screen. Okay.
And Devin, you'll give us the date for the next meeting before you leave, I'm sure.
I don't determine that date, but I certainly, if there are dates to be proposed, I'll weigh in on whether or not I'm available.
Well, we meet every 3 months.
Mm-hmm.
So 3 months is what? November, December, January. And today's what? About the 20th? I think that's
Unit
Martin
is
Luther
currently
King.
set for January 27th.
Thank you very much.
Thank you, Jason.
At 6 o'clock again. Thanks, Jason.
So, John, we've
So the
got,
discussion of the defined contribution plan, who's going to,
so that, we've got Laura Hancock of Mission Square, formerly ICMA. She is on the line.
okay, Devin, thank you very much for your presentation. That was excellent.
All right, thank you. Would you like me to stay on the line or shall I make my way?
Personal choice.
Yeah, I don't think it's necessary.
Okay. All right. Well, let me know if any questions or comments come up, and I will hope to see you all soon. Thank you.
Sounds great. Thanks, Devin.
Thank you.
Bye.
Thanks, Devin.
All right, Laura, welcome.
Hi, good evening. Can you guys hear me okay? I can
Yes.
Yep.
turn my volume down because I can hear myself really well. It's kind of strange. All right, so thanks so much for having me tonight. And sorry, I'm going to turn this down a little bit. Okay. So I was asked to just kind of go over and review with you guys the 457 and 401 plan that is now, or that is with us. So just to clarify, so ICMARC, we did not get bought or sold or anything like that. We just simply changed our name. We've been around working with municipalities since 1972, and throughout the years, we started as just working with town managers, and then over the years it evolved, and we actually helped create the very first 457 plan, put that out there, and then over the years it's kind of changed where our mission has always been serving others that serve the public, so the betterment of government. However, it's expanded from just town managers and municipalities. We've also worked with now the K through 12 and public hospitals and things like that. So Our mission hasn't changed, so that's why we decided to put mission in our name. And then square is just the idea of the 4 different sections that we work with, but also the town square. You go to there as a public space to talk, to discuss things. So we put it as Mission Square Retirement is our new name. So just to give you a little background on the name change and why it occurred. So we've been around for almost 50 years and we're not planning on going anywhere. A few years back when we first started working with you guys in 2015 on the 401 plan, at least, there was a lot of people out there, kind of, different different record keepers. Now it's really not that many that we're seeing, but we're still here, and and enjoy the relationship that we've had. So I have been with Mission Square since 2000. Gotta remember now, 2013. So about 8.5 years now. And my colleague used to handle the Monroe plan. He retired. So then I took it over after another person that didn't work out. So through the pandemic is when the town of Monroe was basically reassigned to me. So I have not had the pleasure yet of meeting anybody in person, and hope that will change soon. But as I've been going through things, and I always look at it as anytime there's kind of a change in the person that handles things, it's also an opportunity to look and see, okay, what's working well, what's not, what can we do to make it better. And specifically with that in regard, we looked over the 401 plan because I was asked to kind of put together like a summary document of how the plan works. And I realized you guys have an individually designed plan document. So one of the things I would kind of suggest is possibly just utilizing our model plan document that it has an IRS approval letter. Anytime there's any changes that occur with the IRS regulations, it's automatically updated as a negative election within our plan. So there's not a need to go back out and modify the documents to do so. Whenever there is some sort of a restatement, which we're going to be going into one of those pretty soon anyway, where the IRS just makes the documents kind of cleaned up and everything every so many years. It just kind of is a lot easier to do when it's under our document. We don't charge anything extra to do that. So that's just something to consider overall, that we can kind of clean it up and make sure that the wording is what you want, and you don't have to then worry about it, because as the plan sponsor, you are officially the fiduciary on the plan. So we want to make sure that you're following all the proper IRS rules and such. So any questions on that before I kind of go any further? No. Okay. All right. So that's on kind of the 401A side. So when someone is a new employee, they have the option to receive this, like what's called a plan highlights form. And it just simply tells them who's eligible, what their requirement is, how to enroll, what their match is going to be, what their vesting is, and any kind of withdrawal provisions. This is just on a quick little one pager. It also has my contact information. So should they have any questions, concerns, they don't understand what a fund is, what kind of fund is the default, what does a default mean, what are these target date funds, how do they work, that kind of thing. So I like to just make sure that everybody knows that they do have that contact, that one-on-one kind of, whether they really want my help or need my help, I just want them to make sure that they know they have it. We've also enhanced our website. We have a mobile app. We have a whole financial wellness center within our website as well that people can go in once they've enrolled in their plan and set up their online access. They can go through and update their profile and kind of customize it to what works for them. And then also, because the 401A plan is kind of set in stone, you can't change your contribution amount unless there's some sort of a contract change for that entire employment group. 3% savings is what they're required to do. The average individual it really should be saving probably closer to 15 or even 20% if they really want to retire and have a healthy, sustainable retirement. So then we also have that 457 plan. So that's something else that there's different optional provisions that you can allow on the 457. For example, just recently it was added that you can basically auto enroll someone into their 457 as a part of their employment. You just say, okay, we're going to set up this 457 for you, and then they can elect to not do it, but it just makes it a little easier to help people save when it's automatic like that. Most 401k plans do that already, so this was just kind of been extended into the municipal market. The other thing that's available now is a Roth option. So if people want to contribute on an after-tax basis, that their withdrawals are tax-free upon separation and meeting certain IRS requirements, they can do so as well. The limits are the same from a 457 perspective. So 19,500 is the current year maximum limitations. And whether that's done via Roth or pre-tax, it's a total combined of 19,500. Of course, if they're over 50, then they can do the catch-up option. And then there's even the pre-retirement catch-up option. So again, just kind of helping people understand that they have this 401 plan that they're required to do. And then the 457 is a voluntary plan and how it can help benefit them as well. And we can look into any of those optional provisions that you would like to do, or if you wanted to do those for the employees as well. And now before I took over the plan, there was a fee structure change on the plan. And so rather than kind of having the fees built right into the expense ratios of the fund, so that would be the administrative fee specifically, they decided that I wasn't part of this conversation, but it was decided to have it a little bit more transparent. So the fees were externally charged. And actually, it was brought to my attention that even though they were externally charged, there was the expense ratio of the funds wasn't changed, and we were actually manually going in and reimbursing that fee back into the participant's account. So we simply just changed to a zero revenue share fund, so that we no longer had to do that internal reimbursement of everything, and now it's all just kind of set up properly. So with that being said, all of the funds that you guys also have in these plans are our standard lineup. We do offer open architecture. So if there's ever an opportunity that you are, either looking as a committee to add different funds available, because we are a sole provider here, so we're the only option for the 401 plan, we do offer that option to be able to utilize any publicly traded fund out there. When towns do decide to do that, they usually do work with a consultant, kind of like Fiducian, around the state, so that you're kind of having that monitoring of the different funds, so that you're not having to take on that fiduciary responsibility as well. But that is just something that you have available to you should you ever want to do something like that. We can accommodate. All right.
Laura, this is Ron. Laura, this is Ron. Can I step in for a sec? So what I included in the packet were the 457 adoption package and the plan and trust. So unlike the 401A, we do use your model plan for the 457, correct? And
yes, for the 457 you do. Yes, I'm sorry. So
right.
Just the 401 is where you have that individually designed document.
Right. And I believe we became aware that we automatically adopted the revised plan unbeknownst to us, but not that that's a bad thing, because we're in compliance with the IRS, correct?
Correct. On the 457, yes. And that's kind of just an automatic, like the 457 is just a simple thing because it's not, sorry about that. So the 457 is kind of just like a standard IRS document. There's not really any sort of individually designed document for that anyway.
Okay.
Sorry if you hear my dog barking in the background. Apologies for that. Okay. Any other questions or anything for me, or did you want me to review? Oh, I should tell you. Hold on. I was pulling up the plan. So there's currently in the 457 plan specifically, there is about $7.8 million in there. There's between the Board of Ed and the town side on the 401, there's a little bit over 700,000. And then actually the town does have a separate standalone Roth IRA, just simply a benefit to the employee. It is not a fiduciary obligation of the town. It's just simply the town is the payroll, basically assisting the payroll benefit of it, so that when a participant really wants to do a Roth IRA totally separate from a Roth 457, they have that option to do that right through payroll deduction. And that one actually has just about a little over $650,000 in that as well. So total combined assets through your payroll system and through the town is a little over $9 million. Total of 235 participants, and 224 of those are actually contributing currently. And actually, I'm sorry, that's just the 457 plan. It shows as 224 actively contributing over the last 13 months. No, 81. Sorry, I'm like looking at something different and then it came up. So 81 actively participating in the 457. And then the other ones are a little different there. 30 in the Roth IRA. So really, we're seeing some pretty decent participation rates as well. But obviously, my goal is really just to make sure that those that are not participating are aware that they can and what benefits they have available to them. And then those that maybe are already participating to just review their accounts, make sure they're taking full advantage of those options and opportunities available to them. And I guess the only open item is just if you guys do want to adopt our standard document or our model document, again, I think it would just take the burden off of you to not have to worry about making sure you're still in compliance with the IRS.
Yeah, that's what we're doing about.
Yeah, so to that end, I think we could get some more information on that.
Do we have to talk to legal on that?
Yeah, I'd like to get our
Attorney to
pension counsel to look at that, and then we can take it up.
Make a decision on that. Yep.
All right,
So-
and I can send, and I think I may have already sent it, but I'll send the blank adoption agreement that has comments on what you need to fill in and why this section's important, things like that, and then if you're ready to do it, it's just a matter of submitting it back to us.
Okay.
Forward.
Great. Thank you very much.
All right.
Thank you, Laura.
All right, you're welcome. So unless you guys have any other questions, I'm going to go say hello to my kids that just came home.
Right ahead. Thank
And
you
your
very much.
dog. Feed your dog.
Yeah, my dog. Thank you. Have a great night.
Thanks, Laura.
Okay, just quickly before we adjourn, to get it for the record, today's Thursday, October 28th, 2021. This was the meeting of the Pension Committee and Opeb Board of Trustees joint meeting today. Thank you very much. I would just have a motion to adjourn.
To adjourn?
So moved.
Second from Dave, from Anita. Thanks very much, everybody.